Which clock am I using? There's one over there that says we got about 5 minutes, and the one on my phone says we've got about 2. Oh, okay. I'll give it a couple minutes and then I'll get started. Yeah. Respect everybody's time, not to take any longer. Respect to everybody's time. Yeah. I realize you've got time and you've got money. You can use one or the other, but only one of them can you make more of.
No. This is Keller Williams Southland Parker time runs a little bit behind the rest of the world. So we'll give it a couple more minutes.
Okay. Well, then I'll wait till what Tom says he's ready.
Yeah. And we usually show up when things are starting.
That's all right.
We don't like to be
okay.
1,480. Yes. Okay.
My motto is I won't be early.
We have.
I won't be late.
We
but I
do
won't be
have.
early.
Okay, so you need an estimate or approximate, or do you need that? Okay, all right, I'll find out. All right, thanks, Amy. So do you have the vertigo today? Oh, it's the worst.
The main thing is I feel like I'm stumbling. I feel like I have to tell people, no, I'm not drunk yet. It's just the way I'm walking. I promise I haven't been drinking yet.
Morning.
I'm okay. How you doing? You too. Tom told me I had to wait for that clock to be 10.
Good idea.
You know, I almost put my other designation on there, something nobody knows about, and then it finished with, it's a CGMA, Chartered Global Management Accountant, and then a BFD. Big freaking deal. Yeah. Spend a lot of money to get all those credentials and nobody, a lot of time, effort. Staring at the clock. I know.
Tried the axe throwing shop that's down the road from you now?
I have not, because they usually open after we close.
Yeah. Okay.
So, but,
Interesting business.
but I do hit randoms almost every day. Yeah.
Once
Yeah, I just,
before the shot, I don't know who you can.
yeah.
That may be a 4:15. We close at noon on tax day. Everything should be done or extended by that day, and we shouldn't be rushing around because that's when mistakes get made. So it's always been, we close at noon. I take everybody out to a nice lunch. It may be then we may go axe throwing to get rid of some of the stress.
Probably a good idea.
Okay, that is close enough. Let's get started. All right. So I'm
Okay.
that's right. So okay. So I'm Charles Starkey. I'm a CPA, MBA. Oh, okay. You don't have to. I can introduce myself. So I have been doing tax and accounting work since 1999. I've worked with some of the poorest folks, the rescue missions, the city union missions, to some of the most wealthiest clients. When I was at KPMG, we were working on Forbes top 10 wealthiest people in the world type work. In between, I wound up getting laid off in 09. So I started my own business and I opened my office in Darren's office. So I've known Darren since 09. Yep. So that's a little bit about me. What I'm going to talk about is running your real estate practice like a business, how to do things so that you can save money, not just on taxes, but on accounting as well, because everybody wants to save money. So here's our roadmap for today. Treat it like a business, structure it right, save money on taxes, save money with your accountant. Doing these things help you be audit ready, not because I can't tell you that the IRS won't audit you, but I can help you get ready in the event that they do. And then a simple way of doing things for you to take with you. So here's the plan in a nutshell. 2 bank accounts, one for your operations for your bank, for your business, commissions come in, all your expenses get paid out. Every time you get paid, move some over into a savings account set aside for taxes. If you want, it's an optional one, have a credit card. This does give you the ability to not have to have the cash right now to pay for it, but that should be in the business also. Set up QuickBooks, do your reconciliations monthly, set aside time every week to take care of all the accounting for that week. There you go, we're done. The rest of it's just going to be expounding on most of that. So let's start with, this isn't just an agent, you're a freaking CEO. You own a business. You need to act like that. That means your job is to not just grow the revenue, track the profitability, track how the business is doing, and be responsible for the financial health of the business so that it can support you and maybe others. To do that, you separate your business from your personal. Number one thing, keep those separate, a bright line between them. Anything business comes out of your business account. Anything personal comes out of your personal account. If you need money in your personal, move it from the business and then use it out of your personal account to pay your personal bills. Track some KPIs. When you're first starting out, that may be contacts, that may be leads generated, that may be other activities. When you've been in real estate for a while, it may be your conversion rate, it may be what your cash flow is, how many houses you've sold, what the value of those are. So key performance indicators. These are things that if you track them and manage them, they have an outsized impact on your business. You know, like if I'm selling a $50,000 house, I'm going to generate less money than if I'm selling $1 million house. So one of them may be the size of the listings, what the value of the listing is. And then you need to run on a calendar, set things on there. It's not working in your business, you hear, it's working on your business, setting that time aside each week to review how you've done, what you've done, do your accounting, and try to grow the business, what you can do better. All right, so got the part about that that's the business and you need to treat it like it. So structuring your business. For almost everybody that I talk to that wants to own a business, real estate, attorneys, construction, my advice is start as an LLC. Generally, a single member LLC. This provides some legal protection. I'm not an attorney, so you'll need to talk to the attorney about that. But it provides you flexibility. If you start as a single member LLC, the IRS is going to tax you as a disregarded entity. That's the same as if you just hung out a shingle. The LLC gives you flexibility to change that in the future. Whereas if when I go out and just start doing work, I don't have that option because I'm not structured as the LLC. And those options will depend, can come down the road if the math works out for you. So to set up, you're going to need the LLC that's registered with the Secretary of State. You have to get a tax ID number. You need an operating agreement. Go to an attorney, have them set it up. Yeah, I know you can go online and register with the Missouri Secretary of State. You can go to the IRS. That doesn't generate the operating agreement. I was thinking about this. It's like for sale by owner. Hey, I can go sell my house. Why do I need to pay the commissions? Because you're going to get a better result when you use a professional. So the attorney's job is to try and draft things to protect against whatever can go wrong on there.
Hey, Charles,
Yes, Tom.
can you expand on operating agreement a little bit?
So this,
Keep on properties with an LLC, and then when I first went to close on one of my first deals, it was like, okay, we need a copy of your operating agreement. Oh, what is that?
see, this is where these are the things that the attorney draws up. The state requires you to have an operating agreement. Now, it doesn't have to be written, but you have to have one. If it's not written, it doesn't really exist. This tells you how the business runs. When it's a single member, when it's just you, it's relatively easy. You know, it's boilerplate. There's a bunch of stuff that the attorney that has to meet state requirements for it to be in there. It's what happens in this case. How are you taxed? So being able to make distributions, things like it's something that the attorney set up. I don't touch them. I read through them because if it's just you, it's going to have one tax code section. If it's two people, it's probably the same one. But if we want to change you, that we'll get to later, to an S corp, that section that they're referring to as partnership law, and that needs to be changed to S corp law on there. And you need to go to the attorney and have all those things changed because this is the legal document on how the business runs. So separate business banking from personal. That's going to be a common theme. Keep your books current and your records organized. Another common theme throughout my whole presentation. And then a simple written business plan. This can be one page. How am I making money? Then review it every year. What worked? What didn't? When my son was in Scouts, after a camp out, what do we need to stop doing? What went badly? What went great? What do we need to keep doing and improve? Okay. Roses, buds, and thorns. Okay. I'll get to that. The actual reason I want you to do that here a little bit. So let's start with talk to Lonnie. He talked about this is a way of building wealth. So I'm starting with the balance sheet on here. Most businesses look at the income statement because that's where your tax draws from. Your balance sheet tells you what you own, cash, assets, what you owe, loans, car payments, and what your net worth is today. That is essentially, you took all your assets, liquidated them, paid all your liabilities, what's left over. If you have to put money in to pay your liabilities, then you're negative. If you still have cash left over, then you're starting to build wealth. So when you're profitable, that adds to your equity. But when you pull money out of the company, that's reducing your value, reducing your wealth on there. And the accuracy of this report comes from doing your accounting, keeping it up to date, doing the reconciliations. I told you that was going to be a theme. All right. Now, what most people are worried about, taxes. Here's my income, commissions, fees, whatever else I get paid. My expenses, so subtract those off. What's left over is your profit. A friend of mine is fond of saying, income is vanity. I made 100, 200, 500,000 in commissions this year. Profit is sanity. I don't care if you made $500,000. If you lost 25,000, you're not running a great business there. If you made 40,000 and your profit is 30, then that's showing you're being a better owner and trying to grow a business, actually make a business. So income, you're pretty familiar, commissions, sell a house, you get the commissions off of that. I know agents that will add additional fees on because their time has value to it. So that's your income. Expenses must be ordinary and necessary. MLS, super key, mileage. We talk about mills in a little bit. Those are ordinary. Don't tell me you wanted to buy a helicopter. That's not something that's ordinary. No, you cannot buy a helicopter,
I
Tom.
want to buy a helicopter, but man, I tell you what, this is one I struggle with. I had this conversation with Nate. Like, when are we not real? Like, every meal I have is a conversation about real estate. I mean, if it's with her or if it's on the phone, I mean, at what point I feel like I should be able to write off almost everything in my life. So I'm always real estate.
You can until you get audited.
Oh, I get it.
So I will talk about mills in a little bit. I've got a few items that come up frequently, and not just in the real estate world, everybody. But I did have an electrician who said almost the same thing. Hey, I've got to take care of my tools, and I am the biggest tool in my company. And we all thought, you are a pretty big tool. So, nope, I was already there. No. Document not just what, but why. So Tom, this is for you specifically. You want to say the mills are, why do they count? You buy something. Maybe you have a handyman that comes out to do repairs on a house. What house? What was it? Why were they doing that? You know, you've got the receipt. The IRS requires the receipts and the proof. It's the why you did it that also is not necessarily discussed in there, but if you document it on those receipts, then if you ever have an audit, you can say, yeah, here's where I paid this handyman to come fix this house. Here's why, because this leak and this on there. And assume if you get a tax document, the IRS has it also. So there you go. Look at what the first one is, Tom. Mills. So these are some special items. Mills, you get a 50% deduction. You have to document who, what, when, why, where, and why. Get your receipt. We talked about random. Lonnie and I met for coffee at Random's. You get a receipt. It'll say Random's Coffee. It'll have the date. It'll have the order on it. So now you've got the where we met, when we met, what was purchased, and then I could say Lonnie Branson discussing real estate and working with agents on it. And it'll tell you meet those goals. You have to meet all those. It has to have a business purpose. The primary goal is to generate revenue. Doesn't mean you're just meeting with a client. I work with attorneys. I work with financial advisors. We go to build that relationship and strengthen it so that we can cross-refer, because you're going to do work with people you know, like, and trust, and you've got to build that relationship. Home office. That's another one that it gets. It depends. So that's going to be most of the answers, is it depends. It has to be exclusively for the use of the business. So your kitchen table isn't going to count. It has to be regularly used for the business on there, or it can be a place of meeting people. It doesn't have to be a whole room. Like we could say this whole room, or I could say, hey, I've got a 6x6 desk with my office computer set up in it, and that's my office. I have maybe in a guest bedroom, and here's a bed and here's a closet that they use, but this space right here is exclusively for me on that. So there's a couple different ways to calculate that. I'm not going to get into it. If whoever you talk to, me or somebody else, you're doing it on TurboTax, it's going to get into the nitty gritty of the square footage versus the square footage of the house, or the simplified method.
Back to the meal thing.
Yeah.
So you said 50%. If you've got two people, then that's great. You're only taking off their part. What if you are entertaining or taking out 4 people?
50%. Yes. Yeah. Yeah,
You still live
yeah,
there. You're all cleaning.
There's no free lunch.
yeah. Now let's say you have an open house and you bring in uh, a tray of food. Okay, that's more of a marketing expense, not a meal on there. And you're running from appointment to appointment and you drive through McDonald's. That's personal, not business. So,
But if you are having a meal ticket, that's not considered marketing.
no, it's not. It's meals. See? And this is why it depends and why there's so many questions. What was that? Who were you meeting with? Why were you meeting them on there? Entertainment, not deductible. Don't give me your Chiefs and Royals tickets and tell me you want to write them off.
You should give them to a client.
You got to prove it. And then it gets to a little bit more questions in there. Health insurance, again, it depends. It gets more complicated. My wife has worked at Farmers for 30 years. I own a firm. I've got 8 other people that work for me. I could have health insurance through the business, buy it for everybody else. But because of the way the health insurance rules work, since I have access to group benefits, I would not be able to deduct my portion of it. If I'm going to use Tom and Sandy, thank you. Tom and Sandy are my aunt and uncle. I knew I was going to make that mistake. I knew it. I'm assuming they have health insurance because they're both self-employed through this. They would get to take that deduction as a better deduction, self-employed health insurance. Okay. So again, it depends on you, if you're married, what your spouse does, if they have health benefits through work or not. Life insurance, generally not deductible. Generally, there are some exceptions. Fines and penalties. I don't know about you, but whenever I put in a location and Google tells me it's 20 minutes, I look at that as a challenge and want to get there in like 17. Speeding tickets, traffic tickets, not deductible. Not paying your taxes and getting assessed fines and penalties, you don't get to write those off. So,
What about the agents who get fined through the MLS?
that's not a legal one. That's fine. Okay. This is for this is for you did not obey the law and the government slapped your hand. Okay. Yes.
So on health insurance, if you're getting Medicare and you have to pay, whatever, is that deductible?
Again, it depends. Are you married? Does your spouse work?
Yes, but he doesn't have.
Okay. Then what we typically do is, yes, Medicare can count as part of your self-employed health insurance deduction. The way your tax works is here's your income, here's some adjustments to income, here's your adjusted gross income, then you have deductions. Self-employed health insurance is an adjustment to income. So you get it before any of these other deductions. Health insurance in general is deductible, but you have a whole bunch of other stuff you have to overcome, including the standard deduction of about $30,000 married filing joint. So it's generally difficult to itemize, which would mean you're not deducting your health insurance. Okay. Vehicles. Let's talk about vehicles. At the end of the year, I always hear the commercials about come buy a new vehicle, talk to your accountant about special tax section 179, section 179, immediate expensing, or bonus depreciation. You can write it all off. Hey, if I owe a lot of money in tax, I'm gonna go buy a vehicle. So you go buy a $60,000 truck. You save $16,000 in taxes. You're still out $60,000 in cash. And when you trade that vehicle in, because it's a business asset, you have to recapture that depreciation that you claimed, that 60,000, at a 28% tax bracket. It's great the first year, but when you trade it in, you find the catch on it. Not saying that's a bad thing. It's just a thing to be aware of. Whereas if you have a vehicle and you put it in, keep it in your name, you track your mileage. This year, you're 70 cents a mile deduction. You don't have to worry about that when because it's not a business asset, it's a personal asset. So you don't have to worry about that trade-in and what the tax implications are on the trade-in on there. So it's not a simple buy a car, write it off, or take mileage. It's a more complicated answer, and it depends on how you're doing, what you're doing, how long you own a vehicle, a whole bunch of set of facts and circumstances so that we can get to what's the best answer for you. And tracking your mileage, you've got Mile IQ and other things that you can use in your phone, and it's just swipe left or right if it's business or personal. All right. So I didn't really have a good place to throw this slide in, but I think it's important. Your commissions come in lumps. You sell a house, you get a portion of them. They don't come in like a payday every week, every 2 weeks, the 1st and the 15th. So this is where the operating account comes in. You put your money into your operating account. Then treat it as the business and pay yourself a regular salary. How much do you need to live on? Let me pay myself $1,000, $1,500 every 2 weeks, every month, whatever it is, and move that over from my operating account to my personal account. So when I'm looking at paying for my bills, because gas, water, electric, mortgage, they all come in monthly. They want that money every month. December, January, you may not have sold a house. You may not have any commissions. So you treating it as such. Here's where my payroll comes in. Now, we do some of the other things, there may actually be a paid salary, but otherwise, just moving it over and treating it as here's the money I'm contributing to the house. Is that a question? Oh, okay. Helps you create a pattern. This is what's going on in my life, how much I have to spend this time. Choose the date, set the amount. If it's not enough, adjust it quarterly on there. And this allows you to build a buffer in your operating account. So when slow months happen, you still have the money set aside to pay yourself on there. So you can meet those needs. Lenders want to see you're profitable. Your retirement accounts, to contribute more, you need to show profits. It's not about saying, hey, I want you to pay more in tax. It's, I want you to build wealth, and always showing a loss means that I want to buy a house, buy a car. Oh, well, you're losing money. You can't support the cash flow. You can't support the loan, or you don't have the money, your limits on what you can contribute. Or this is one, you're not paying taxes. You're not contributing to Social Security. So you're reducing your Social Security benefits. So nobody likes giving the government money, but there are other benefits to it. Other things that I've seen people go through from starting at real estate, owning rental properties, flipping properties, going into property management where you're managing other people's rentals. Not things we're going to talk about today. Just realize those are other avenues. They have different rules, different risks. And if you think about those, talk to me, talk to somebody else on there. All right. Let's get into taxes. Plan early. Everybody knows March 15th are when taxes are due. It's not a surprise. Entities are March 15th. That's my next deadline. Okay. Don't try to create deductions you can't defend. I've had people, oh yeah, it was the same. Oh, it was about 30,000 miles. Okay, do you have a mileage log? Sure. And then the IRS says, okay, let's see, mileage, I go, well, I guess I don't have one. Don't create deductions you can't defend. Don't spend money just to get a deduction. That goes back to the truck. You're out $60,000 to save $16,000 in tax. Much better option, create a retirement account. And again, don't let April be a surprise. Let's talk early, talk often, estimate where you're at, how it's going, so you know what to expect. This time of year should be the end of the tax line, not the beginning. May, June meetings, so that you've got about a third of the year in through April. July, August, September, and November and December. Now you know where the year ends, mostly likely where you're going to wind up and what you can expect from it. All right, some of the other retirement plans. There are a whole bunch of options here. IRAs have the lowest amount you can contribute. You've got SEPs, you've got simples. You can do a 401k. You can do a Roth of each of these now, thanks to the Secure Act or Secure 2.0. You can do traditional, depends on when you want to pay the tax. If you're younger, you may want to do a Roth because it's going to have more growth. If you're older, you may want to do a traditional, so you get the tax savings up front.
But Charles, on the, like kind of where you're at, Aaron, I'm figuring out my taxes and then I have this tax bill. And then one of the ways I can lower that tax bill and then kind of pay myself is to contribute to an extra amount to what my IRA will allow me to do, right?
Yep.
Or if I don't have one, let's just say it's my first big year in real estate, man, I got a ton of taxes. What are some of the things I can do, right? And one of those is if I open up an IRA, I can do that. I can open up an HSA, health savings account, and that also helps me write off. So those are some,
Now, since it's February, almost March, you're too late on everything except for an IRA for last year. But
you can contribute up to the last day, right?
415 on your IRA. But if you had a big year, you expect to have another big year this year, you may want to consider the SEP, the simple 401k. And there's not up there, but there's also profit sharing plans and defined benefit plans. Defined benefit plan is an old-fashioned pension plan where you're putting away 250 grand a year. So there's lots of options just from being self-employed that have higher limits than just the $7,000, $8,000 in an IRA. S corp. So this is one that I have a lot of discussion about. First, you have to be an LLC to convert to an S corp. That's why I say start with the LLC. It is not a decision that you make lightly. You can, let's say you have the LLC in place for 25, you can convert up to March 15th, retroactive to January 1 of 2025. The big things with an S corp. One, you have to pay yourself a reasonable salary. Two, you have a separate tax return you have to file. The corporate return is due March 15th. It generates a K-1 that throws off the profit that you then pay tax on. The tax return for a corporation, here's your income statement, here's your balance sheet, a bunch of questions in between on there. So you got to keep up with the accounting on there. I was in the Navy and the reserves in supply. Our saying was the Navy floated on a sea of paper. The government wants their piece of paper. When you an S corp, you have to run salary, payroll, even just for yourself. Even if you don't pay yourself, you still have to file the quarterly 941s, the Missouri 941s, the Missouri state unemployment tax. Yes, you're paying unemployment tax on yourself, federal unemployment tax. QuickBooks, just for the software to do it and to file the zero reports, they're going to charge you $60 a month. Missouri, if you don't send them their unemployment reports, 1 month late, they charge you $100. 2 months late, they charge you $200 because you didn't send them their piece of paper. So it's not something that you go in and out of. It's what I tell people, when you have $20, $30, $40,000 in profit, then you consider it, because real estate is cyclical. I started my business in 09. I was dealing with people who were doing short sales and were for house foreclosures. And if you were real estate at that point, I've got a seller. I just need a buyer.
So what's the advantage of being an S
The
corp?
advantage of being, well, LLC is not a tax form. So you're talking about a sole proprietor. On a sole proprietor, you have income, you have expense, you have profit. You pay 15.3% into FICA, Social Security. You pay, estimate about 20% federal income tax and 4.7% Missouri tax. 40% of your profit goes to the government. The benefit of the S Corp is it allows, yeah, that's a shocking number, isn't it? It is. The benefit of the S Corp is it allows you to control, not eliminate, the amount that you're giving it to the government for FICA. FICA funds your Social Security benefits. So by reducing that, you're also reducing your Social Security benefits. And definitely need to pair this with a retirement account. Okay.
So with the S corp, I pay less in self-employment tax
Correct.
or none.
No, you have to pay some. You have to have a reasonable.
But on the back end, when I become Social Security eligible, I might not be fully invested or funded, or I might not.
You'll probably still qualify. There's different things for funding that. And knowing you, I know you're going to be fully funded anyway. But, right. But, well, it takes, you have to have 40 quarters to qualify for Social Security. A quarter is, I don't know, $2,500, $5,000 is a quarter. It was $1,250 at one point. You can never have more than 4 quarters in a year. So, you know, you make 10 grand in a quarter, you still get a credit for a quarter on there.
Well, I heard this story the other day, and this kind of goes into random, I'm sure. I was just at lunch yesterday, and the guy was telling me about a guy that owned an alternator repair shop and started a repair shop and used to come to the drag strip with loads and loads of cash, right? Because he ran cash to his business. And my accountant told me as long as I just show about 35,000 a year profit, I'm good. Nobody's ever done that. Right? So he just converted most of what he could in cash. But here comes, he gets older, and here he's at the end of the line. Well, guess what? He's not getting diddly squat. Social Security, his shop's gone, and you know, he's living in a little cabin in the woods kind of thing.
Yep. Penny's told the story about the barber at her hometown. Penny works for me at her hometown, where he never showed any profit, and then gets ready to retire and realizes, I don't have any Social Security, because never paid into Social Security, because always showed no profit to avoid paying taxes. So, and to avoid that, take control of your retirement and pair it with a retirement account on there. I mean, last year you could put $70,000 in a solo 401k with employer match on it. That's the same deduction as going out and buying a new truck. One goes up in value, one goes down in value. So,
Kind of in a nutshell, for agents that kind of more established, higher income and that sort of thing, and consistent, let's just say they're above 100 grand consistently. That's where the conversation might start in that ballpark of looking at the S corp.
I'm going to look at your profit, because if you're consistently 10, 15,000 in profit, it's going to cost you more to do the corporate return, to do the payroll compliance, and then to do your individual return on there.
Assuming they run a profitable business.
Yeah.
And then really the thing you're weighing out is, on paper, you might save X amount of dollars because you don't have the self-employment tax. Let's just say that was 10 grand, but you may spend an extra 5 grand or 4 grand or whatever in accounting, and you're just weighing that out.
Yeah, exactly. Yeah. And it is a pain to get, it's easy to get into. Like I said, we can make a retroactive election to last year. I had somebody call me yesterday who inherited a property in Arizona. He didn't talk to anybody. He said, well, I guess I'm going to put it in an LLC, and then I'm going to make it an S corp. And I talked to him, and I'm like, you really shouldn't put a property in an S corp. And to get it out, you have to make that by March 15th. There's no option on there. So he's kind of stuck with it for last year, but we can fix it for 26. So, yeah.
So if you start to make more money and you're more profitable, can you still stay a LLC? You don't have to go to.
No, you don't have to go to it. The LLC gives you the flexibility to make that decision. Okay. That's why you use the LLC. It gives you options. If it's just Charles Starkey doing business as Starkey Real Estate, there's no entity there that gets to choose. I'm stuck with being a sole proprietor.
But once you go S corp,
Mhm.
you can't like jump back and forth.
No.
How your year runs, right?
Right, right. And that's the problem,
You need to be consistent to
Mhm.
make that leap.
And even if you're consistent, the economy isn't, 08, we had the markets tank, real estate tank. If you had a buyer, you were great. You could help them out. If you had a seller, you may or may not. 2020, if you had the seller, you could get whatever because there were a lot of buyers and not a lot of sellers. So, that's a 10-year span. Yeah.
I have a question on the you backdate that, like you were talking about some of the other situations, like if you wanted to get LLC for 2025 taxes.
Ask the attorney.
Okay, fair enough.
Because the attorney's the one that's going to be creating it. They have to go, they have to register it. And really, what do we do when we're doing? Your LLC is public information. You go to the Missouri Secretary of State, there's a business entity search, you put in the business name, you can pull it up. It's going to put your filing and creation date, and that's what we're looking at. Okay.
One try, based on some experience we had last year, we were told that you really could, we were trying, for insurance purposes, we were trying to decide whether to go at court. So we had to get our LLC for our business, we've been doing business, but not set up as an LLC, Karen did it. So once we had decided to do the LLC, we had to get that done before December 31st, 2024, for us to consider the S corp option, i.e. also some insurance possibilities, because they had to have this look back in our turn. That's what our push was, to get it done by the 31st, so in case we wanted to do it for 25. We looked at all those numbers and went, yeah, it's too much hassle. Like, if it didn't make sense for us to do the S corp version, but we're an LLC, and not an accountant, but on ours, we still are doing like a Schedule C type of a thing, but you can't, depending on how you're filing your taxes, it doesn't really matter if you're just doing the Schedule C like you always do.
Yeah.
That's what I'm thinking, it has to be whatever that year is.
Okay.
Now, another one, I'm going to tell you the theory behind it, and I'm going to tell you my experiences. Hire your kids. It has to be real work. They have to track their hours. They have to get real pay, so you have to be paying them a salary. Got to keep real records of the hours they work, minimum wage. It's great because you, mom and dad, higher income taxpayers, kids lower income. So the income goes from a higher income to a lower income. They now have earned income because they get this W-2. You can take that and use it to invest in a Roth IRA for them, where they pay tax on when they earn it, which is going to be 0, and it'll grow for tax-free when they pull it out. Great in theory. I had my son come work for me. He worked for me 3 hours. He didn't like that he was having to pay into FICA, because that's the other thing. You're also take FICA out of them. You don't necessarily have to if you're a sole proprietor, but as a corporation, I did. You take FICA out of there, you're starting their contributions into Social Security much earlier. He didn't like that he had to pay FICA. He didn't like that he had to wait till payday to get his paycheck. Grandma and grandpa owned a furniture company, and he would help move mattresses and get paid cash right then. So he worked for me 3 hours. So if you're talking about this, they have to do age appropriate work. How old did you say they were? Okay. 14, they can do light office work, you know, filing, shredding, answering the phone. Yeah, exactly. Exactly.
What can't they? Mean, I have to go clean out a house.
They're your kids on there. Yeah. They're your kids. It's not the, you're not hiring somebody else's kids and putting them in harm's way. So kind of the child labor laws are, we're going to assume mom and dad are not going to have them doing hazardous work that could result in a loss of an arm or getting killed.
I guess what you're saying is I can't make my 14-year-old vice president of my company and get him a $90,000.
Correct. Correct.
Like I do that, you know, I asked him if he'd help us do some landscaping,
Mhm.
and he's like, what? That's you.
Mhm. Yeah, but you know, you get, but we're trading you for that. We're, you get food, you get a phone.
I've always, like, back at corporate, I 1099 kids all the time, so. But as long as I kept it under 600 bucks, nobody knew, right? And now they've raised that.
Starting in 2026, so on the 2027, 2 grand and indexed to inflation. So that number will go up every year.
I mean,
1099, but it's much better. But by doing that, you're not they don't have earned income, so they can't contribute to it. You're not making them pay into Social Security, which Social Security benefits are based on your best 35 years of earnings. So if you've got a 14-year-old, you're starting those 35 years early on them. So, okay. One thing I didn't include that I need to go back to on your taxes. Track where you're selling your houses. Cass County, Missouri tax. But we're really close to a state line. You sell a house in Kansas, Kansas wants their tax because it's there. If you sell a house in KC, Kansas City, Missouri wants their 1% earnings tax. Way. So, all right, how to pay your CPA less. I'm telling you, these are the things that I see that, yeah. Well, my job is to help you make more money and keep more of your money. I'm not going to recommend things like the S Corp. I know accountants that say, you start a business, you want to be an S Corp. Let's go ahead and set it up. I'm telling you $20,000, $30,000, $40,000 in profit. Yeah, I could charge you for your corporate return. I could charge you for your payroll. But I want to do what's best for you, the client. Do the right thing. A customer always comes first up there. So these are the things, and we send out a accounting checklist. It's what we're going to use if we're doing your books. Reconcile your books before you come in. We're going to look to see if they're reconciled. All the bank accounts, all the credit cards. If we do it, we're charging you. If you do it, then it's done and we don't have to charge for that. Yeah. Bring your mileage receipts, I don't need your receipts. I'm not auditing you. I'm not the IRS, but make sure you have them. Give me the mileage logs, give me the totals on there. That's what the IRS is going to demand. If we're doing first year-to-date financials, again, reconcile your accounts, prior year returns, big change list. What's changed? I bought something. I sold something. I bought a car. I sold a car. I invested in retirement. I have a kid. Kids are going to college. I'm retiring. Big life events can have big tax implications. One of them, death and taxes. Somebody passes away, the first year, the year that their spouse passed away, they're filing joint. Next year, the income probably didn't go down as much as expected, but the taxes go way up because your income's about the same, but you go from joint return to a single return. It's a big tax impact, especially if you're on Social Security because of how Social Security. Be quarterly, not annually. Yeah, it may cost you a little bit more, but our job is to try and save you on taxes. Either, hey, did you fund your retirement account? You need to fund a retirement account. You need to convert to an S corp. You just need to pay more in estimated payments into it, so that the government's not hitting you with penalties at the end of the year.
When we talk about estimated payments,
No.
should we be doing that?
Yes.
Yes, always.
Yes. The government wants their money. If you're not a W-2, and if you are on an S corp, you're going to be getting a W-2. We can adjust your withholdings to meet your taxes through that. But let's assume you're not. You're a sole proprietor. The government wants their money. They want it quarterly. If they don't get it quarterly, they charge you a penalty for not paying on time. Your payment dates, your first estimated payment of 2026, 4/15. The same day you have to pay whatever tax you owe for 2025. So you may have two big checks to the government due on April 15th. 4/15, 6/15, so June 15th, September 15th, and January 15th of the following year at the due dates. Yeah.
Finish it out.
Mm-hmm.
You haven't paid quarterly,
Mm-hmm.
and then you send in a big amount at the end. Is that a problem? Because you're
As always, it depends. So the default and what all the tax software does is, last year you made $40,000 in profit. Here's your estimated payments. Let's say it's $8,000 a piece. Bang, 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 bang. You start off slow. You can't pay $8,000. You can do the non-default way. The way that takes a little bit more time and effort is annualizing your income. How much did you make in the first quarter? How much in the second? Based on those dates, and say, well, this was the profit. This is what I should have made. And you can use that as a way to avoid the penalty. It takes more time. It takes more effort. Most of the time, accountants, myself included, we run it through the software. If we have these discussions, I have a few people that are in trades, and January, February, November, December are slow for them. We figure out what the totals are. We then reduce the first and fourth estimated payment and bump up the second and third to kind of counter the, I can't drive a truck when it's snowy, can't work outside when it's cold, so not going to have much on those 4-month periods.
So don't just wait.
Right. Yeah. Because, yeah. And because when you annualize, you're going to have a spring and summer in there. It's better than not, because you have made something. But doing the estimates, doing on time, kind of figuring out where you are for the quarters on it.
If you just hit the big check, like she talked about in December, you're gonna get penalty, you're gonna have penalties.
Yep. 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 Like I said, the government wants to spend your money. So they're going to force you to give it to them, or they're going to charge you extra for not. Now, let's say you put that money in something that makes money for you. The S&P 500 last year returned 17%. Before that, the year before that, it was about 24%. Maybe you make the rational decision that I've got my money invested in something that is doing very well for me. I'll make my money, and then I'll pay the government the interest, the penalties. That's a legitimate business idea also. Yeah. Yeah.
Make a sale $10,000 and you just put away 25%, because that's, federal and
Right.
whatever. And then you just send that in, quarterly, whatever, 25% of whatever you make.
Right.
And then you end up getting a big refund. Is that bad? Is that you should not do that?
Well, let's say you have a refund. we can either get that money back for you, or we can apply it to your estimated payment so that you don't have to take the money, take it on the next big estimated payment. And maybe you want to do that because then the government's already got your money. And you can also review, maybe I'm making too much in estimated payments on here because I'm basing it on my gross commission, and that's not taking into account all the expenses I paid. So there's a lot of things that play into that, but yeah. DIY versus delegate. You're responsible for your receipts, mileage logs, documenting business purpose for everything. You can go to a bookkeeper. They're going to charge you less than I will to keep up with your monthly accounting, to keep up with your reconciliations, to look at what's flowing through QuickBooks and saying, okay, is this mills? Is this where? What is it? And then you come to the CPA for the strategies, for the filings, and taking care of notices that you may receive. Oops, wrong button. Talked about this all along, how to minimize your headaches, keep your books current, vehicles, mills, home office, loss year after year. Those are the four the big ones that the IRS looks at. Consistent systems. If you're doing this on a consistent basis, it's going to minimize all these things and respond quickly to notices. So clean up and separate bank accounts and reconcile them. When start collecting mileage, determine your KPIs. What's important to you? What drives your business? What activities that you do generate more for you? Set aside what you're going to take as your percentage and set your schedules. Weekly, your accounting cleanup, your monthly, reconciling your bank accounts, quarterly, doing your tax filings and meetings. I think that's it. Any other questions? Comments? It does. It does. Sure. Yes,
Big question, are you taking on a client, and if so, when?
we
Not
are.
for this, not for 25, obviously.
Well, we'll take 25. Yeah, we do. But yes. Anyone else? You think what? Oh, you probably weren't here. My ears aren't working. I'm kind of hanging on to this so I don't fall over. And it also means I'm not hearing so well. Oh. Oh, well, tell her hi also. She used to work for me. She was there. Well, we won't go into that. Yeah. No, no. A receipt or two isn't that bad. Now,
So it's not like that straight, it's just.
realize that if the, if I'm in the trades and I have Home Depot, I'm going to assume it's supplies. Okay. You also, if you're using QuickBooks, you probably have a smartphone. You can take pictures and attach them to your, attach the photo to the expense in
Right,
QuickBooks.
that happened after, but
Yeah.
like, say like you're going to grab something and they don't ask you for the receipt, you walk off, and crap, they didn't.
Yeah.
Not a big deal.
How much are you spending? Okay, so really it's going to cost very little. And that's if you get audited and if the auditor questions that particular expense. If it's an ordinary expense on there, then okay, it's probably not going to be questioned. But the technically correct answer is yes, you should ask for a receipt every time. I do that, and I've done that, and my wife would make fun of me. Now I notice she does it also, because if you have to return something, you have to have the receipt.
I have a question. So if you put meals on a credit card,
Mhm.
so I always don't get a receipt because it's on my credit. statement. And if you only, and like Tom was saying, like me and him are both in real estate, and we go out, and we're always talking about real estate, a lot. So if you just took all your meals and then only deducted half, is that okay, or is that like a audit?
So the IRS uses statistical analysis. If you, I'm assuming your husband?
Yes.
Okay, if y'all go out to eat, every time you're going out to eat, you're writing it off. Your expense is going to be high, and they're going to be like, that outside of statistical norms, that may be something that creates an audit flag on there. Because husband and wife going to dinner isn't a business meeting, even though you may talk about it. I go to work dinner with my wife. I ask her how her day went, what kind of stuff she's working on at Farmers. She asked me about what we're dealing with sometimes. It doesn't make it a business meeting. It's not there to generate revenue for you. It's just.
Okay, so, but one of my question is, so should I be getting a receipt for
Yes.
all those, for meals?
Yes.
Or going out to coffee with the client?
Yes.
Get the receipt?
Because the receipt requirement, let me show you here. The who was there, what the business purpose was, the rest of it, the what everybody ordered, and not just the here's what the charge was, but the itemized breakdown of what everybody ordered, when, because the date and time are usually on there, and the where, the name of the restaurant or coffee shop is on there.
Right.
All those things are on the receipt. All you have to do, take the receipt, write who was there, what you discussed, what the business purpose was. Okay, that's the easiest thing with mills on it. Yeah.
And when you get the receipts, quick, I mean, my dad would always just grab the receipt and write right there what he was saying. Same as meeting with one of his builders.
Yeah.
Lunch meeting regarding next phase of whatever subdivision, within about 30 seconds.
Exactly. Yep.
Put it on his credit card.
Yeah.
I
Right.
guess I didn't think a receipt was necessary because I had record on my credit card. That's why.
Yeah.
But it doesn't answer those questions.
Right. And the credit card just says whenever they batched it through. So like if I go to dinner on a Saturday night, it may not show up on the credit card until Monday. That's the batch. Yeah.
They are looking for your physical receipts, not, here's my cookbook file with my breakdown. So I just wanted to-
All of the above. Okay.
It depends.
Yeah. Well, in this case, no, the actual answer is all of the above. So we have a client that started as a partnership. He bought out his partner and converted to an S corp. We told him for years, you need to do payroll. You need to do payroll. I'm too busy. I'm too busy. I'm too busy. And the IRS says, hey, maybe you're not too busy for us. We're going back and looking at your 2022 because we don't believe you paid yourself a reasonable salary of 0. And then a week or two ago, the IRS agent, okay, we're expanding to 23 and 24 also on here. The document request, all the LLC foundational documents, operating agreement, all the stuff I said you had to have there. If you're using QuickBooks Desktop, they're going to want you to strip out, because the desktop has this function. We want that 12 months or maybe 14 months, December the year before and January the year after to see these things. We want all the checks that you wrote, just because you code check 1, 2, 3, 4 as to whatever doesn't mean it is. So we want all the front and back copies of the checks from the banks. It was a 2-page document request for that stuff. We want your payroll reports. This is why we ask for payroll reports when we're doing S corps. We want to agree what all your 941 say that the salaries were. Agree that to the W-2 and make sure that flows through to the to your general ledger, to your financial system, so that it flows into the tax return correctly. Not that y'all have to do this, but sales tax we treat the same way.
Question, you mentioned your construction guys being seasonal. There's a seasonal aspect to this
Right.
business as well. In fact, it almost looks the same, November, December, January, February,
Mhm.
but it's slower than traditionally the year. So if you were coming, if an agent started working with you, you looked at the previous year, and you said, you know, we need to be $5 grand a quarter, 3 quarterlies. That could be changed to where the softer quarters were a little bit lower amount.
Yep.
Maybe the summer quarters.
Yep.
higher.
Yep. Right. Or if you've built that buffer, you know that you've got the money. Let's go ahead and make the payment so that they keep the government happy. Yeah. And it depends on the individual, where they're at, how they operate.
When Joanna asked a great question, we've always taken quarterlies and we just go with the consistent amount, basically the accountant tells us. And if you're coming off a really big year, you're gonna have a big quarterly, and you might not match that, right?
Right.
It'll take a bit volatile. So all of a sudden, at the end of the following year, we had a good year, but not or there's this nice big amount of money that IRS is holding for us, and boom, there's our first quarter for the next year.
Yep.
So really, I've always kind of enjoyed that.
Yeah. I hadn't thought of it until I started running my own business. You make estimated payments. You overpay the government. Let's say you've overpaid by $1,000. Your normal estimated payment is $3,000. Why are we going to tell you to write a $3,000 check and wait for a check from the government for $1,000? Why not just net them and say, just pay the government $2,000?
And that accounts for your first quarter.
Right.
It's not like, oh, you do it. And by the way, you also.
Yeah. The only, and by the way, also is if you owe for 25 and you have to make estimated payments for 26, then it's 2 checks.
But if they give you a refund and you say just keep it for the first quarter,
Mhm.
but you don't know how your you know how your first quarter is, but it's less than or it's more than, isn't it kind of complicated to try to figure out now what do I owe the second quarter? Do you know what I'm saying?
Yeah, I do know what you're saying. Yes. And everybody says, oh, my taxes are pretty easy. Yeah, well, not necessarily. So, but yes, we can, what do you expect? I know what the software is going to do. The software is going to say that this year your total tax was $10,000, $2,500 a quarter. Okay, so next year we want $2,500 a quarter. Well, maybe you don't want to do $2,500 a quarter because the first and fourth quarter are going to be slow. So we may do 1,000 on the first 2 and then make the 4,000. Is that right? 4, 8, 9, 10, something like that. Make those differences up and then apply there. So we figure out what the totals are going to be, then we apply.
I think, Charles, the 15 or 20 people in this room, we're all in different situations.
Exactly.
Some of us have spouses that work, some don't. Some work in the business, some don't. Different income levels, all these different factors. And, we need to have individual consultation with a professional on these things.
Yeah.
And in my meetings with our agents last year, I just kept getting the same request over and over again. And it was for this. We don't need to be experts in all this stuff. We need to be in front of an expert.
Yeah. So.
Oh, can you give everybody your contact information?
No. I didn't put a slide with it. Okay, so my office is on Main Street, right, almost directly across the street from Random's. It is across the street from Battle Axes on Main, because Gregory moved a couple doors down, made me walk further now. But my wife grew up in Raymore, went to school. She graduated from Ray-Pec. My kids graduated from Ray-Pec. So, what year did she graduate, or did my kids? She graduated 92. My sister-in-law, I think, graduated 95. There are 2 cousins, 98 and 2000. So.
What's your office phone number?
My number 816-331-8500. Web address is Starkey, STARKEY .CPA. Go there. There's a schedule an appointment, and you can go in and schedule a time if you want to.
CPA.com.
No, just Starkey.CPA. Instead of .com, it's .CPA. That's the AICPA has that as a web extension. You have to be a CPA to qualify for that. right. You're welcome.
Thanks, Charles.
Sure. I know, nobody really wants to spend time talking about taxes. It's one of those black boxes that it seems like it's impossible to understand and over your, and that's my job, is to try and make it understandable.
Thank you.
Thank you, Tom. Yes. Okay.
So my husband and I are buying investment properties.
Mhm.
That's what we all.
We do
laughed
them
at.
and then sell them.
So flips.
Similar, we kind of keep them longer.
How long do you keep them?
So, like about a year.
Okay.
But my question is, when we buy, when we put it into its own LLC,
Okay. Is that what you are doing, or is that your question?
we did do, we just.
Okay.
We purchased it. Like. A real estate investment.
Mhm. So when you are in the business of buying and selling property, that property becomes your inventory. All the you buy the property, it sits on your books as an asset, as inventory. All the costs you incur to fix it up go, so you're not writing anything off until you sell it, and then you're taking all of that against it. I would, if you're going to be doing that, I would make it one LLC, 4 flips like that. Okay, so I wouldn't do each one individually. Oh, absolutely. You want me to? What? Right. Because it'd be like I own a clothing store, and each shirt I bought, I created separately.